The Brexit vote may not have been as close as people think. We'll have the details. Plus, we'll explore the growing trends of nationalism and globalization. This is 7 Day Yield.
Happy New Year and welcome back to 7 Day Yield. I'm Lydia Morish.
I'm Mitch Roschelle, and here's what's trending. Artificial intelligence is a term that's getting more and more attention. While it means different things to different people, this catch-all category includes everything from robo-advisors to chatbots, and VC firms are lining up to support AI startups. One recent PwC study reports that a staggering $2 billion was invested in AI in 2016. Good news is we are not being replaced by robots just yet. According to PwC Financial Services Institute, 3 out of 4 wealth manager decisions are being made by humans.
New technology tools are becoming more integrated into the operating models of many financial institutions. And this is being fueled by the growing trend of application programming interfaces, or APIs. More and more firms are using APIs to let third-party app developers create tools to offer new services and to engage new customers. However, cybersecurity remains a top concern with these emerging technologies.
Last June, the Brexit vote sent shockwaves across global financial markets. But what has it done to the confidence of market participants? Recent PwC research suggests that European businesses are far less optimistic than they were just 2 months ago. To get more on Brexit from a local perspective, I recently sat down with PwC UK-based partner Craig Hughes in London. Take a listen to hear what he had to say. Craig, I want to start with Brexit, and I know we've talked about it a lot, but we had an election in the United States, and there's talk about that being a landslide. Was Brexit as close the way people think it was, or was it in fact a little bit more of a landslide?
Yeah, that's very interesting. So 52-48 is what the basic information tells you. If you break down the vote by parliamentary constituency, it was 421 votes to leave, 228 to remain. That's a landslide. But even if they go back to Parliament, as MPs, 421 of you have got constituents who voted to leave. So can you really change that? I don't think you've got the mandate to, so you're going to have to follow through with it.
Let's stay semi-political for a second. One of the other issues that we're hearing a lot about in the United States is the need to invest in infrastructure. Yeah. And I'm curious if that's a global phenomenon as well. And if so, is private capital lining up to participate in the infrastructure spend?
So there's an absolute drive to invest in real assets, whether that be infrastructure or not. And there's a real need for that infrastructure. There's bridges all over the world, there's transport problems, there's a lot that's needed. So the money is matching up with that need, and it's coming together with real estate, because infrastructure and real estate are about creating place, not just space. So it's all coming together.
There's also a pothole in front of my house that I'd like fixed, but that's besides the point.
I'll talk to an investor about
that. Yeah, we get that fixed. So the other thing that seems to be a global phenomenon is, historically low interest rates. We've seen in the United States the 10-year Treasury start to move up. We've seen other benchmark indices around the world start to move up. Are we at a sort of a precipice of something happening to the real estate industry globally as rates rise?
Well, it's interesting. People are under-allocated to real estate even before they started to move in there because of the spread over bond yields, etc. So as interest rates rise, some money may move away from it, but there's still a huge amount of capital looking to be deployed into real estate that just can't. So I don't think...
Why can't they? They can't find deals?
Well, it's global capital, and real estate's a local business. So how do you bridge that divide, global to what is a very local market? 2 buildings on the same street can have completely different dynamics. Right. And there's a struggle going on as to how they do that.
But if capital just aggregates more and more and more on the sidelines, at some point, so the scale tips over because there's too much uninvested capital, when does the first foot happen into the market where that capital gets freed up?
Well, a lot of that capital has been sitting on the sidelines now for 4 or 5 years. One of the biggest sovereigns who announced they'd go into real estate, if you look at what they've deployed, but you look at the growth of their fund, they're actually further back than they were when they started off. So, that capital is trying to get in there, but it just can't at the moment.
You mentioned that infrastructure and real estate are lining up a little bit. Is that helping this cash on the sidelines phenomenon because they have multiple avenues to go down?
I think it is, because they can go into infrastructure as well as into pure real estate. I think one of the issues that needs to be solved is there's a huge supply-demand issue around affordable housing. So you've got a huge issue about supply of housing. You've got a lot of capital. How do you get the right environment and the right regulation to allow that capital to solve that housing problem whilst also making a commercial return. Where that is solved in different jurisdictions, I think that's going to be a huge opportunity to get that to work. And around building that housing, you need infrastructure. So again, that is an opportunity for the capital. At the moment, in some jurisdictions, the rules don't allow them to make enough of a commercial return from that. So how do we solve what is a really important problem, which is the housing crisis?
To help us make sense of these growing trends, we are joined by our very own Dr. Alexis Crowe. Alexis, thank you for joining us.
Thank you so much for having me.
So Craig talked a lot about the impact of political uncertainty following Brexit, but there seems to be a lot of investment and attention focused on the U.S. as well. So talk to me a little bit about the impact this may have on investors.
Absolutely. So we're seeing a threefold impact on asset prices, equities, and the U.S. dollar. So primarily, if we're looking at equities, we've seen $70 billion of inflows since November the 8th, and that's matched by an extraordinary amount of outflows from emerging market equities and bonds. We've seen the largest amount of redemption since 2008 in emerging markets, and so we might call that the Trump tantrum.
I'm going to be tweeting the Trump
tantrum.
The other thing you talked about was the strength of the U.S. dollar. So think about global multinationals. Is the impact of a rising U.S. dollar going to have a shift in corporate profits at all in the U.S.?
Absolutely. So Mitch, like John Donne, we were talking about the UK earlier,
Yeah.
John Donne said, no man is an island. We might say no country is an island. So if we look at the United States, you have 90% of consumers sitting outside of the US. And the stronger the dollar goes, the greater an impact that has on American competitiveness for exports abroad. For every 5% increase in dollar, you see a 3% negative earnings on the S&P 500, and also a 0.5% drop in GDP growth over time. And so as we look to the longer term, a stronger dollar has a negative impact not only on competitiveness for US companies, but also we have issues of emerging market debt. So $3.3 trillion worth of non-financial dollar-denominated debt sitting outside of the United States. And that has a tremendous impact when countries can't service that debt. So that might become a distressed investing opportunity.
For the last 8 years, we've really focusing on getting the economy back on track. But what you're saying is potentially the strength of the U.S. dollar could be something that creates a new headwind for the U.S. economy?
It's the #1 risk on my dashboard this year.
The #1 risk on your dashboard. Okay, now I'm nervous. Well, don't go anywhere, Alexis, because we're going to keep you for the entire show. When we come back after the commercial break, we're going to be talking more about the nationalization trend, so stay right with us.
Major revenue recognition accounting changes will take effect soon. Are companies prepared? Are you? Find out with PwC's Revenue Recognition Survey Data Explorer. In a few clicks, see how your readiness compares to your peers. And explore areas of focus to prepare for coming accounting changes. Visit pwc.com/US/RevRec survey to learn more.
Welcome back to 7-Day Yield. I'm Mitch Roschelle. In keeping with the EU-UK theme, Lydia recently sat down with Andy O'Callaghan to get a sense of the impact of Brexit on European wealth managers. Take a listen.
So in recent months, we've seen this trend towards nationalism, conservatism. With Brexit, we look at the U.S. elections, we're starting to see that a little bit more in the rest of Europe. So how is that going to impact the asset management industry, both in the U.S. and also in Europe?
Individual populations in different countries are saying we want more. We feel we've been left out, right? There's that disconnect. What we're seeing in Europe, and what we will continue to see, is a questioning of whether the European Union is working for the citizens of Europe. That's the question that ultimately led to Brexit. What that means for financial services then is that it's just a more volatile environment. It's harder to make decisions. It's harder to decide how to invest and where to invest. There are still opportunities, but you just need to be much more aware of how the rules might change.
Mm-hmm. And touching on Brexit for a moment, when we get into 2017, how are clients preparing for the potential outcomes of what Brexit may lead?
So the big challenge here is that we don't yet know, and we won't know probably for another 12 months actually, what the outcome of the Brexit negotiations between the UK and the rest of Europe are going to be. 70-80% of our clients have really detailed plans in place. The concern is going to be, when do we pull the trigger? So when do we start to execute these? Do we wait till the end of negotiations and say, okay, now it's clear? Or as it unfolds and it becomes clearer, even though the final negotiations won't be in place, do you begin to look to change operations? That's the key questions clients are going to face over the next 12 months.
We talked a bit about in the U.S., when the new administration comes in, this repatriation of wealth back into the U.S. So what's that going to look like for multinational companies?
That's a trend that you'll see right across the board, right, where governments are asking their own companies, particularly where they are large international global companies, what are you doing for our country, right? You are based in our home country, and that requires certain obligations to be fulfilled. That includes tax, and then if you have large reserves of cash offshore, how do you bring those back in a way that doesn't disadvantage the shareholders, but it certainly meets reasonable demands from governments and from the citizens of those countries.
Mm-hmm. So obviously, with all the changes going on, it can create a lot of volatility in the market, but with volatility, that also brings a lot of opportunity. So when we're looking at 2017 forward, what are the opportunities here?
So I think there are huge opportunities for the industry, right? What we're seeing globally is an increase in global AUM. So it varies by country, but in certain countries, particularly in the emerging markets, there's increased affluence, large amounts of money available to invest and to save, and our clients are doing very well in providing solutions to those markets. And that will continue. Despite the backdrop, some of the challenges that we're talking about, there will be new opportunities, and I think our industry is going to continue to grow and to thrive and to provide solutions for investors.
Alexis, you're back. Thank you.
Thank you.
So Andy mentioned that in volatile markets, it's often difficult for companies to make decisions. But rather than focusing on the negative, volatility can also bring opportunities. So what opportunities can we see in lieu or in spite of patriotism?
Even if the worst comes to the worst and we see huge trade barriers coming up, you still see opportunities for growth in new economy sectors in high-income countries. So technology, healthcare, and services. In the middle income, where we're still on the cusp of new and old economy growth, so industrial and manufacturing, as well as looking at healthcare and services and technology, there's still significant opportunities going forward in those sectors. And in the lower income, we also see long-term opportunities in manufacturing, industrial capacity, land play in Africa, for example, and real estate. Some of our clients are being able to take an investment approach. We spoke about the strong US dollar. So if you're a US company buying in US dollars, emerging markets can look very attractive for the longer term if we consider this kind of moment of protectionism to be an interregnum.
Interest rates have recently been on the rise again. And so how is that going to impact perhaps the stronger dollar?
We might see 3 to 4 rate increases this year. And so, that combined with this proposed border tax, if that is implemented, we might see a 15% uptick in the US dollar. So in the United States, that's got a significant increase in consumer prices here in the United States. But outward, again, a strong buying capacity for distressed assets abroad. Again, we also talked about that US dollar-denominated debt. So we might see an uptick in M&A activity with emerging market companies selling assets to be able to fund their own debt.
When you go through those 3 cohorts of nations by wealth, where does Vietnam fit in all of that? Because in some of the things that you've written that I've read, I do read your stuff.
Thank you.
One of the things you talked about is the emergence of nations like Vietnam in terms of being an alternative when wealth is being reallocated. So where does Vietnam fit and why is it attractive?
Absolutely. So I would say it's a lower to middle income Asian country. And what we're seeing Vietnam benefit from is what we might term a manufacturing diaspora from China. With higher wages comes a higher disposable income, and the consumer piece of the story starts to come in.
Does a middle class get created then in that process?
Absolutely, absolutely. So the worry is at the moment that is this age of protectionism here to stay? Have we gone back to the 1930s? And the reality is, I think we'd like to look at it as an interregnum, that this might just be a period where the trade winds go silent for a bit. But still, I think you'll still see a strong piece, and that means a buying moment and a buying opportunity in Vietnam.
Great. Well, thanks so much, Alexis, for sharing a set with us and for all these insights. We're definitely going to have you back. Next week, we will be shifting our focus back to the United States. We look forward to having you then.
Thanks for watching. To catch up on previous episodes, be sure to check out our PwC YouTube page. Plus, you can follow us on the Twitter handle below. We'll see you next time on 7-Day Yield.